Good morning and welcome back to the desk. Where numbers don't lie, liquidity reveals the truth, and every line on the balance sheet tells a story the markets try to hide. Today, we look at a headline that's sending a quiet tremor through Wall Street. Major U.S. banks have once again turned to the Federal Reserve for emergency liquidity, drawing billions through the Fed's lending windows as tightening credit conditions squeeze margins and confidence across the financial sector begins to wobble. The figure may not dominate the screens, but it whispers louder than any chart, because when banks borrow from the Fed, the market listens. Investors know this isn't a move made when liquidity is cheap and confidence is overflowing. It's a move made when something beneath the surface starts to crack. Now here's the hook. While banks reach for temporary funding, a parallel drama is unfolding in the silver market. Large short positions betting against rising silver prices, are suddenly facing an environment where rising physical demand, tightening supply streams, and geopolitical metal stockpiling are pushing prices higher, not lower. For months, the silver market has simmered with quiet tension. But when liquidity tightens and collateral valuations shift, those who bet against precious metals often feel the heat first. The question emerging across trading floors tonight is simple: how long can leveraged shorts withstand price pressure before margin calls force liquidation? Because history shows that it's never rising prices alone that break a short, it's rising prices arriving while liquidity drains. And that's exactly why these two storylines matter together. When banks tap the Fed, they aren't just filling a cash gap, they're signaling funding stress across the system. When that stress rises, we see accelerated pressure in leveraged markets, and precious metals often become the battleground where liquidity meets reality. Silver has always been an emotional metal, a wealth metal, a panic metal. Its behavior changes when confidence breaks. And what we're seeing right now is a market where physical premiums remain elevated, where vault withdrawals increase, and where global industrial demand, from solar manufacturing to battery technology, keeps tightening the available supply. These are not speculative fantasies. These are measurable fundamentals converging at the same moment banks seek stability from the Fed's balance sheet. Imagine this: a trader sitting on an oversized short position, expecting prices to fall, suddenly finds collateral value eroding as liquidity costs rise. The margin requirements shift. The phone rings. It's the risk manager. And overnight, the strategy that looked profitable turns into a slow, burning fuse. That's the kind of pressure cycle that historically triggers forced covering. Not because traders want to close positions, but because the market forces their hand. And every short that becomes a buy order pushes silver just a bit higher, tightening the coil, fueling the narrative, drawing in new buyers who never looked twice before. It's the kind of feedback loop markets fear and speculators live for. Ladies and gentlemen, tonight is not about predicting an explosion. It's about acknowledging the pressure building inside the casing. When banks borrow billions for stability, when metals gain momentum under tightening liquidity, and when leveraged positions start to feel the ground shift, smart money steps back and asks, what chain reactions are set in motion when liquidity leaves the room? Markets don't collapse on headlines, they adjust on pressures. And sometimes those pressures rewrite the rules faster than any analyst can type a report. When banks begin returning to the Federal Reserve's lending windows, borrowing over $17 billion, the financial system sends a signal that cannot be ignored. Liquidity is tightening, credit stress is rising, and institutions that once relied comfortably on private funding are now looking toward the central bank as a backstop. And here's the hook: banks don't borrow from the Fed because things are going well. They borrow because other doors are slowly closing. It's the economic equivalent of quietly turning on the backup generator before the lights start flickering. This shift suggests not just isolated weakness, but the early formation of broader financial tension that could reshape risk appetite across the market. Rising interest rates have reshuffled the cost of capital, making traditional funding more expensive and less predictable. Banks that once relied on the wholesale funding market or short-term lending now find those channels tightening as counterparties demand higher premiums or pull back exposure altogether. The market is quietly acknowledging uncertainty, and the institutions closest to the flow of money are showing it first. When banks secure liquidity from the Fed, they signal that maintaining cash reserves has become more essential than maximizing returns, because liquidity is survival, and survival suddenly matters again. Investors can ignore the headlines, but they cannot ignore the message. If liquidity pressure is mounting today, stress in credit markets could accelerate tomorrow. What makes this moment particularly compelling is the illusion of stability that still lingers in public perception. Stock indices can stay green even as liquidity dries up beneath the surface, giving the false impression that everything is normal. But liquidity stress always begins silently, behind closed doors, measured not in price movement, but in borrowing patterns. The public rarely sees the warning signs until they become undeniable, until a bank is forced to admit losses, until credit spreads widen overnight, until a funding freeze triggers forced selling. And by then, the story is no longer about prevention, it's about damage control. So when banks tap the Fed for billions, it's more than a routine transaction. It's an early warning shot that market participants with privileged insight are preparing for turbulence. The institutions borrowing today are not acting out of fear, they're acting out of necessity, and necessity speaks volumes. The seeds of systemic pressure are often planted quietly, and liquidity is always the first battlefield. If banks are fortifying their positions now, the real question becomes, what are they preparing for, and why aren't more people paying attention? The quiet tension building beneath the surface becomes even more revealing when we look at why silver short positions are suddenly under pressure, and why that pressure connects directly to the spike in bank borrowing. Silver is not just another commodity, it is a leveraged battlefield where paper contracts multiply physical supply many times over. For years, major financial institutions have used short positions to suppress volatility and stabilize pricing. But now, as funding conditions tighten and liquidity becomes more expensive, the cost of maintaining those short positions is rising faster than most analysts expected. That's where the real story begins, because when financial players lose the ability to cheaply roll over their short exposure, the entire artificial pricing structure built on derivatives starts to wobble. Silver shorts rely on a steady stream of low-cost capital to maintain downward pressure. But with banks paying more to secure liquidity, and in some cases resorting to the Federal Reserve, the cost of holding leveraged paper positions becomes a burden rather than a strategy. Imagine balancing a heavy weight on a thin metal rod. As long as the rod stays straight, the structure holds. Once it bends even slightly, the weight shifts, wobbling toward collapse. Rising funding rates, depleted liquidity, and higher collateral requirements are bending that rod right now. And here's the hook. Most market participants won't realize the risk until forced liquidation begins. And by that time, silver's price could move violently before traders even have time to react. What makes this particularly dangerous is that silver exposure is not isolated to speculative traders. Banks and hedge funds have layered structured products on top of short contracts, creating a web of positions that depend on stable borrowing costs. When those costs rise, losses accelerate and margin pressure forces decisions that markets can't ignore. If even a fraction of short sellers are pushed to unwind simultaneously, it could ignite a chain reaction where each liquidation drives the price higher, which then forces more liquidations. It's a classic short squeeze dynamic, but amplified by systemic liquidity stress rather than retail speculation. Anyone who remembers the volatility in 2011 knows how rapidly silver can move when physical demand collides with paper weakness. This time, the trigger might not be retail frenzy, but institutional vulnerability. The unspoken truth is that silver's paper market is far larger than the physical metal that backs it. As liquidity dries up and borrowing gets expensive, the question shifts from who wants to close their positions to who can afford not to. Beneath the calm surface of the charts lies a potential storm. If tightening liquidity forces even a handful of major players to unwind, silver could explode upward, not because demand suddenly surged, but because the artificial weight holding it down simply snapped. The link between rising interest rates, tightening liquidity, and mounting pressure on silver short positions becomes even clearer when we follow the money flowing through today's financial architecture. Higher interest rates don't just slow borrowing, they actively reshape incentives, punish leverage exposure, and reward those holding real assets over paper commitments. When rates rise, every dollar borrowed becomes more expensive to service, and every rollover of debt eats deeper into balance sheets. That reality lands hardest on institutions operating with high leverage and thin margins, exactly the profile of traders sustaining long-term short exposure in the silver market. The question no one is asking out loud is this: What happens when carrying a short becomes more costly than covering it? The answer could trigger a shift felt across global markets. Rising rates act like gravity in a financial world used to floating freely. For years, cheap credit allowed institutions to repeatedly extend their short positions without confronting their true costs. But as funding becomes more expensive, rolling over these positions turns from strategy into strain. A short position is not static, it demands constant financial oxygen. The margin requirements, interest costs, collateral obligations, and risk premiums all rise as liquidity tightens. Suddenly, the once manageable cost of suppressing silver prices turns into a relentless drain. And here's where the tension thickens. The institutions holding these shorts are the same ones facing broad portfolio pressures as rates climb. When balance sheets get stretched, something has to give, and historically, that something is the leveraged exposure that becomes too costly to carry. There is a compelling hook hiding beneath these mechanics. If interest rates continue trending upward or even stay elevated, the cost-benefit equation flips dramatically. At a certain point, not theoretical but mechanical, shorting silver becomes financially irrational. That moment doesn't require a surge in physical demand or a sudden drop in supply. It requires only the steady grind of higher borrowing costs, eroding profitability. And in a market built disproportionately on derivative exposure, even a small rebalancing of short positions can ripple outward. It's like pulling a single thread from a tightly woven fabric. Unexpected tensions emerge in places previously thought secure. The dominance of paper silver means the system's strength rests not on physical availability, but on the willingness of leveraged players to continuously pay to hold the line. What happens when they stop paying? This is where the broader picture comes into focus. Rising rates are not just influencing consumer loans and mortgage payments, they are rewriting financial risk across the market. Institutions holding silver shorts face mounting pressure, not because silver is spiking today, but because the economic environment is squeezing their ability to maintain artificial price suppression. The higher the rates climb, the thinner their margins stretch, and the closer we come to a moment where covering short positions becomes a necessity rather than a choice. If that moment arrives while physical inventories remain tight, the result could be swift, disorderly price movement, driven not by hype, but by mathematics. When banks quietly increase their reliance on the Federal Reserve's emergency liquidity windows, it is not just a technical adjustment, it is a signal that internal funding channels are tightening faster than they can patch the leaks. Think of it as a lighthouse flashing in the fog. Most people sail past without noticing, but those who understand navigation know a hidden coastline is near. The $17 billion borrowed may not break the system on its own. Yet the act of borrowing tells us something deeper, that private liquidity has become more expensive or less available, and institutions are preparing for scenarios where market funding could suddenly vanish. In financial history, major stress events rarely begin with a collapse. They begin with whispers of precaution. What makes this moment particularly compelling is how these liquidity behaviors interact with ongoing market pressures. Banks tapping the Fed are not doing so for comfort. They are doing it because holding cash suddenly matters more than signaling market confidence. Liquidity becomes lifeblood when credit conditions tighten, and banks instinctively prepare for shocks before the public ever feels them. Each dollar borrowed from the Fed reflects a defensive stance, a protective shield against volatility that has not yet hit the headlines. And here's the hook that keeps economists watching. Whenever banks prioritize liquidity over optics, it means the perceived risk is already inside the system, not approaching from the outside. This tension becomes even more consequential when viewed against the landscape of aggressively leveraged short positions in silver. Banks under liquidity pressure are in no position to subsidize non-essential exposure, especially exposure that drains collateral and magnifies risk during turbulent periods. When liquidity is scarce, risky commitments become dead weight, and markets start shedding ballast to stay afloat. This is where the possibility of forced unwinding enters the conversation, not because banks desire to cover shorts, but because the cost of sustaining them rises as liquidity becomes precious. The more institutions turn to the Fed's assistance, the more aggressively they evaluate what can be cut loose. Markets sense these shifts long before they are fully understood. Price responses, volatility spikes, and sudden repricing of assets often trace back to unseen balance sheet decisions made weeks earlier. If liquidity pressures build further, The dominoes may not fall in visible slow motion, some could shift overnight. And if silver shorts become one of those pressured positions, the market could face a chain reaction where liquidity defense collides with derivative exposure. The borrowing from the Fed, then, is not the headline. It is the heartbeat of a deeper tension that may surface when the next shock arrives. Stay with us. Because whether this is the start of a silver squeeze, a recalibration of credit risk, or the first tremor before a stronger financial aftershock, one thing is undeniable: the signals are flashing, the liquidity is tightening, and the market is no longer whispering, it's warning. Thank you for watching. Stay informed, stay analytical, and remember, in markets,